clip, we focus on the financial resources needed to run your business. In doing so, we revisit Modules 1 and 4. Every business plan should include a financial section. This section translates everything you have said in the previous sections into numbers. It should show your sources of revenue and income. It may also indicate where funds may be needed and the intended uses, the security you can offer lenders, and how you plan to repay borrowings. Any financial information presented should run for 3 to 5 years. You should include the assumptions behind your projections. First, we will revisit the concept of capital and investment, and then conclude with comments on financial management. For many businesses, capital is the most limiting resource in the long term. As a manager, you should be aware of the sources of capital, be able to calculate its cost, and measure the efficiency of use. Capital can be cash, bank amounts, and monies invested in livestock, machinery, buildings, land, and other assets that can be bought and sold. The concept of capital was introduced in Module 1, Week 1, Clip 2. If you are considering an investment in your business plan, the first stage is to determine potential sources of capital, which can be either internal to the business or external. The use of credit can be an important tool for investment. It is the ability to borrow money with a promise to return the money in the future and usually pay interest for its use. This allows businesses to, for example, acquire productive assets and pay them later with the income they generate. Further detail on sourcing finance for investment in the short term was provided in Module 4, Week 1, Clip 4, and in the long term in Week 3, Clip 4. The second stage is to calculate the cost of that capital. There will be the opportunity cost, for example, the return that could have been made if you had left the money in the bank deposit, or alternatively, the potential returns from other within business uses. If you have borrowed money, there will be the cost in terms of the interest charged. Finally, you need to determine the efficiency of the use of your capital. First, whether the investment is feasible. How long does it take to recover the capital? Second, whether it is worthwhile. What is the rate of return of the investment? The income generated over and above costs. Simple techniques to determine these were outlined in Module 1, Week 4, Clip 1, and an example of an investment opportunity was explained in Module 1, Week 5, Clip 1 and 2, in considering investments. The concept of discounting future values was also explained. See Module 1, Week 4, Clips 2 to 4. Even if you are not necessarily considering an investment, you should still include some financial details. Changes in marketing, production, or management will have financial implications, and these implications should be presented within a set of financial budgets. If you are borrowing money, the lender, whether external or internal, will particularly wish to see these. Module 1, Week 2, Clip 3 introduced the 3 most useful financial documents: cash flow, profit and loss, and balance sheet. It is recommended that you include some cash flow budgets. 3 years provides a useful indication with greater breakdown, such as monthly in the first year and less detail in later years, for example quarterly. You may wish to extend the number of cash flow budgets to the point when they become normalised, such that the impact of an investment costs and repayment are no longer apparent. This does not necessarily mean you would need to include 10 years worth of cash flow budgets if it takes 10 years to pay off a loan, but the first 3 years and a year 10 cash flow budget could be beneficial. You should also include profit and loss statements. Further details on profit and loss, albeit from an accounting point of view, were provided in Module 1, Week 2, Clip 4. Clip 4 from Week 3 also provides useful guidance in terms of developing a whole farm budget. If your business plan is based around changes to individual enterprises, gross margins for these would be useful to include. Revisit Module 1, Week 3, Clip 1. You may also wish to make use of partial budgets, looking at the benefits of a partial change against the cost to see whether there is a net gain or loss. Revisit Module 1, Week 3, Clip 2, if you think this technique would be useful. Break-even analysis is also something you may wish to consider. Break-even analysis determines the break-even point of a proposed change, which is the point that the benefits of the change are equal to the costs and there is no net gain or loss. Break-even analysis can be used to determine break-even output levels such as crop yield or crop area. It can also look at the level of application of particular inputs or for technology selection. Revisit Module 1, Week 3, Clip 3 for guidance on this technique. Thank you, and I look forward to seeing your business plans.